lots of challenges with keeping up with the pace of inflation, and sometimes they have to look and maybe up the risk a little bit, to keep up with inflation. If you're just going to leave your money parked in a savings account, checking account, CD, money markets over the long haul, we're going to lose some purchasing power. So
And welcome into the program. This is your game plan for retirement with Northwestern Ohio's resource for a common sense approach to planning for our money, our investments, our finance, our retirement future. He is president and founder of McIntire Retirement Services. Chris McIntire, home of the game plan for retirement, your game plan for retirement, ladies and gentlemen. The plan, the document, the tangible thing that you can have in your hands that shows you the steps and the places that your money should be going to work for you, that you can turn to and have some confidence and reassurance that you are doing the right thing on the right path and making progress. And Chris, we always appreciate your time here on the program. Is it hard to plan effectively when the government can't even spend money correctly?
well, they haven't been very good at it for a long, or I should say they've been very good at spending money, maybe not so good at saving money is probably a good analogy. And here we are in the middle of a shutdown. And again, depending on, the airing of the show and all of that, where exactly is it? But, um, it can lead to volatility in the markets for sure, right? Because, a lot of the government functions are idle, workers are furloughed. We're hearing about air traffic controllers, and that deals with, not just you and I flying down to Atlanta like we're going to have to do here coming up for our, when we get together with our group of buddies, advisor buddies from around the US. But also think of UPS, FedEx, DHL, if some of those planes and cargoes and, just in time inventories can certainly, get derailed. And I think for the average investor, the average American out there with a kind of a moderate view of everything in the world, right? The middle class, we just get sick and tired of it. Why can't they pass a budget, for crying out loud? These continuing spending resolutions are very hard to fund a military and get companies like Lockheed Martin that are, that we invest in when we buy the S&P 500 index fund, and many other companies that it's hard for them to plan long term when they don't know where the money's coming 6 months from now, as an example.
We all have to live within our budget. We couldn't just continue to overspend year after year perpetually. And why can't they get their act together? Yeah, I think is a fair question, Chris, that probably we will never have an answer to, it seems. They'll just continue running up the credit card bill, so to speak. And to your point about air traffic control and those major companies, I think for most average people, you and I and, families at home, if Amazon stops delivering, the world essentially pretty much shuts down. It's not just the government, right?
Yeah, that's a real good analogy right there. Yeah, and I know they show up at my house about every day, and but as we talk about the dysfunction in the government, it certainly can follow itself into the markets, from interest rates with the Federal Reserve, what they're doing, and with the government impasse on everything, does it affect, the value of our U.S. government bonds that many people, especially retirees, have in their portfolios? So, it's not just the S&P 500 that goes down in value. It can be bonds of many different types and sizes as well. So this does have the potential to affect hundreds of millions of investors in the United States and globally as well.
Well, good segue there, Chris, because as usual, I got us off track and down a little rabbit hole talking about the government shutdown to open the program. But we do want to talk about the current interest rate environment, falling interest rates, and how does that affect your money? It was not that long ago, Chris, that we were at basically a 0% interest rate, but inflation was 9%. And so we had a year 2022 when rates were skyrocketing, the fastest pace in decades of climbing interest rates. Now we've entered a new phase, everything sort of being cyclical here. The Fed finally had a rate cut, and we're expecting potentially more of those. What does that mean for our money? What does that mean for our stocks, our bonds, our mutual funds, our bond funds, our safe investments, the yield, the interest that we get at banks and CDs, and also for borrowing? Does that mean that the housing market maybe has a little catalyst behind it? It's been a little slower here as of late because of these high interest rates.
Yeah,
Can't we get
without a
that
doubt,
jump
Peter.
started?
Yeah, without about doubt there, buddy. Didn't mean to interrupt you. But if we turn the clock back here, let's go back to COVID real quick. Quick history lesson. The government came out, when President Trump was in his first term, and, they tried to stimulate the economy and handing out money and whatnot, for stimulus checks and, to keep people spending money and whatnot. But, so many places were shut down. We had supply chain issues, so prices skyrocketed. And then, President Biden got elected and continued that handouts and extended unemployment and all of that, even as we were beyond, certainly the worst of the pandemic, and companies were begging people to come back to work. And they said, nope, we're going to extend unemployment and continue to hand out the checks. And, I suppose there's political motivation to that, right? And so all of a sudden that led to the interest rate increases in 2022. So the government created the inflation problem by handing out too much money to chase too few goods. The Federal Reserve, I suppose we could say, hey, they were late to the game. They should have raised interest rates sooner to calm down that inflation. But, there was so much money out there, chasing too few goods. I'm not sure it would have made much of a difference. Fast forward to 2025 now, and President Trump has been pretty critical of Chairman Powell for not slowing rates or lowering interest rates fast enough. And the Fed's job, as we have in our show notes here that we prep for today, is fair interest rates, full unemployment, and inflation at about a 2% target rate. So the difficulty that they're having right now is inflation is still above 2%. And, we got tariff issues and things like that going on. And what happened, but we also have a terrible housing market. We also have job numbers that are going down. So what's more important, full employment or 2% inflation? So, the Fed's got a difficult job there, and I'm not going to be partisan here whatsoever, other than the fact that I think the Federal Reserve should have started to lower interest rates before. You want full employment, without a doubt, I'd rather manage inflation as a different problem than I would unemployment, because once that snowball starts going downhill, and obviously we have artificial intelligence coming in right now. And who was it? Was it Cisco Systems just recently announced 9,000 job cuts because, hey, artificial intelligence can do what we were paying some of these people. So some of that is, the advances in technologies are driving some of the unemployment numbers as well. And what was it, Peter? You and I were just recently at Brookstone's conference in Dallas, Texas here, and the one speaker was talking and said it was either Facebook or Google. They ended up wiping out an entire department because AI can do what those folks were doing. It was the research side of things.
Yeah,
AI
basically the
does
Google
all.
ads. Yeah, yeah.
Yep.
And I think even Jerome Powell, Chris, has said like last time we acted a little too slowly and let things get away from us. So this time he's on top of it, but still kind of slowing the pace of these interest rates to make any large changes. And I want to remind you, ladies and gentlemen, that if you've got questions or concerns, that Chris McIntire is a resource. So before we go any further into the program and into the discussion about how falling interest rates might impact your money, your wallet, your retirement, if you've got concerns or would like to get a plan put together, like you have accounts, you have your 401k, you have your IRAs, but how does that all come together? How do you generate income? How do you pay less in taxes? How does Social Security work into your plan? How do you address healthcare? All of that is part of the game plan for retirement, your game plan. And if you would like that tangible written plan put together, that's what Chris McIntire offers as part of this program, as the value add for you, as the offer and opportunity. So take advantage of that. No cost, no obligation. Just give a call, 419 332 0532. 419 332 0532. And Chris, a lot of the concern and question that I hear about, and I know you do too, maybe underlying beneath the surface is that number one concern that we always talk about, which is running out of money in retirement. I think that is a big motivation for planning. But right now, the big question that I am hearing a lot is the devaluation of the dollar and what happens when my dollar doesn't go as far. And I think that plays into these falling interest rates, right? The inflation that you just talked about. It's not like we're going to see the dollar wiped out in one fell swoop, but it's death by a thousand cuts here. And when we saw 9% inflation back in 2021, and then we continue to see inflation running higher, that is in fact eating away at our purchasing power and devaluing the dollar. And that's where the Fed steps in, right? That's where their goal, their job is to try to control the pace of that while still expanding the economy.
Yes, and maintaining political independence and whatnot. And, because as much as President Trump has criticized Jerome Powell, he's the one who appointed him to become the Federal Reserve, to be fair. But like you said, Peter, a nice analogy there. Gold is at a record high, over $4,000 an ounce right now because a weakening dollar led by huge deficits and high interest rates and uncertainty around the trade around the globe as well. It's not just the U.S. economy, right? You look at France. France is having real challenges right now. So, many of the things that we're dealing with here domestically in the United States, immigration, inflation, a slowing economy, is also taking effect over in other countries that are, part of the G7, economies and, much of our political allies. I was just reading this morning that how awful the U.S. liquor sales are right now. The U.S. is drinking less alcohol, okay, and then with all the tariffs, our Canadian friends are buying a lot less, along the Kentucky Bourbon Trail down here, and same with other partners overseas.
I think actually, like Chris, a lot of that might be this younger generation does not seem to be drinking, and maybe that's it probably is a good thing, but maybe it's just they have not hit the phase yet. But my son and his peers, like just no interest, and then like those even in their 20s and 30s, I think the consumption of alcohol, you're right, is way down. Just as kind of a side note here. A good thing, yes, probably socially, but there is an industry behind it.
Yeah, there is, and I'm not making light of this, but when we flew back from Dallas, Texas, here we drive through a town called Monroe, Michigan, and it is nothing but marijuana dispensaries. And on Saturday afternoon, about 4 o'clock, I mean, every parking lot was full. So maybe they're not drinking less, but they're sure doing some gummies or whatever.
Other things there. Yeah,
Yeah, it
yeah.
could be a trade-off. Yeah, yeah.
All
But
right.
and the Spike and Led Zeppelin albums might be a signal of
I
that.
see a
But
lot of the younger generation wearing those classic shirts, and
yeah,
I wonder if they even know who they are, right?
yeah,
And then I ask Siri to play classic rock, and stuff from the '90s comes on, and I sort of get a little mad about that. Showing my age here, Chris. All right, well, we are well off topic here now, Chris. So let's talk about these interest rates, right? The Fed controls the interest rates. The Fed controls short-term rates. That's not every rate directly. That is the bank-to-bank federal funds rate, how banks can loan to each other. But it generally does trickle down into cheaper credit rates to boost the economy because a lot of our economy, from the housing market to smaller companies that fund through financing for research development, infrastructure, and all those kind of things. So, should lower rates help to bolster the economy?
yes, that is the idea. Cheaper money, for especially for small companies to go out and borrow money. Higher interest rates really is punitive to them. So lower rates could certainly spur the small business side of things in particular. I don't think Nvidia is too much worried about it. They're just lighting the world on fire, obviously. But if you've got small companies that help support Nvidia or even Whirlpool Corporation that we deal with here in Clyde and many of the other Fortune 500 companies, the cost of capital is huge.
Um, on the other side, Chris, because everything has two sides, if we are an investor or saver that has built up a nest egg, we're not worried about borrowing money, but we're trying to find the best rate of return without taking wild risk, without being in the volatility of the stock market. These falling rates could potentially hurt us.
Yeah, yeah, without a doubt, Peter. If you're a company or a business that wants to borrow money, lower rates is favorable. If you're an investor who is putting up the money that is being loaned, like CD rates, for example, right? We're giving the bank our money and they're going to use it, loan it out, and pay us a difference, and they take the risk of everything. As they lower interest rates, that certainly does have an impact because if inflation is that persnickety, let's call it 2.5 to 3.5% to give it a paint with a little wider brush there. And in the US, that does not include food or fuel. And as we know, meat prices are at record highs right now. That certainly has an impact on the retirees trying to generate income or maintain the pace of inflation as well as interest rates get cut, as we've been seeing with CD rates dropping over the last year, money market rates and whatnot coming down as well. If we get mortgage rates to come down significantly, that could certainly open up that housing market that I think we've said on the show. We kind of call it's been frozen, where people with cheap mortgages aren't going to sell their house and get an expensive mortgage.
But lower returns on CDs, savings, money markets, and Chris, we never expect that safe liquid money, that bank type of money, to completely keep up with inflation. I mean, even back when inflation was lower in 2010 through 2020, like pre-COVID, the bank rates were even lower than inflation. Inflation's still running at 2.5, 3%. Bank savings rates were at 1 or less. There was a period there where inflation went up to 9%, and then the bank rates followed because of the interest rate. We could get a 5% money market or a 5% CD. But now those are coming down now. So what does the more conservative saver or investor do to try to keep up with the real rate of the devaluation of the dollar, inflation?
Well, Peter, great question there. Lots of challenges with keeping up with the pace of inflation, and sometimes they have to look and maybe up the risk a little bit, to keep up with inflation. If you're just going to leave your money parked in a savings account, checking account, CD, money markets over the long haul, we're going to lose some purchasing power. So, try to look in maybe a lock into a higher rate on a corporate bond, for example. Our fixed annuity rates have been holding very steadily because they're more tied to the U.S. government bond market than they are the Federal Reserve rate. So, we're still getting north of 5% on 2 and 3 and 4 year CDs all day long. Or I'm sorry, on fixed annuities all day long. And that's kind of a competitor against the CD side. So, what I mean by that, the Federal Reserve comes out and says, hey, we're going to lower interest rates, let's say 50 basis points or 0.5%. That has an immediate impact on new CD rates, money market rates, annuity rates. That all has to work its way through the bond market. That takes a lot more time. There's still a lot of bonds being issued at higher rates right now. So one way is to maybe change your mentality. Instead of a CD, you look at a short-term MIGA, multi-year guarantee annuity. You look at restructuring your bond side. We use structured notes with Brookstone Capital Management that have some degree of principal protection, but also offer significantly higher yields.
And with those annuities, Chris, that have been the basis for lifetime income and the payout rates that they can offer, the structured income that we need in retirement to replace our paycheck. Now is really the time to look at these before these lower rates begin to work their way into these. I know that there has been record inflow and investment into annuities over like every year over the last several years, but now is really the time if we've got a lump sum and we're going to need to translate that into an income. A saver, an investor, an income seeker really should look at these.
Yeah, they're certainly worth a look for a portion of a portfolio. It's not an all or a nothing by any stretch of the imagination. You wouldn't put all your money in Nvidia stock. You certainly wouldn't put all your money in a money market account, and most likely, you also wouldn't put all your money into an annuity. So a well-constructed portfolio is going to use multi different types of asset classes. The advantage that annuities can do is they can solve a couple of problems with one fell swoop. It could be the lifetime income you're looking for, competitive growth. Maybe you want to lower your fee that you're paying out, right? Annuities pay commissions. They don't necessarily have fees that get deducted every month. Some do if you're using them for income or whatnot. But also some tax deferral. So if you got and I'll just use $1 million in a CD outside of your IRA account paying 4%, right? You got to pay income tax on that $40,000 of interest. If it was inside an annuity, you do not have to pay the tax until you take some or all of that money out. So you can control your tax situation a little bit as well. So we can accomplish a number of different things with an annuity, just like we can with a life insurance policy, like we can with a well-constructed investment portfolio as well, buddy.
And Chris, we talked about the housing market. So I want to make a comparison here with older annuities to the housing market, if you will. Follow me. Is that if we financed a home last year when rates were at 7%, and by next year rates are back down at 5 or 4.5, hopefully for those that are financing, right? The bank would not come to us and say, "Hey, you've been a great customer. We're going to refinance you for free. Like, we're going to bring you down to those lower rates." We would actively have to go out and go through the process of refinancing. So my comparison here to annuities is if people got into annuities 6 or 7 years ago in what was like a 1% interest rate environment, much lower than what we can still get today, then perhaps it makes sense to go out and shop again and see if you could refinance that annuity for higher income and higher interest rates and higher growth and higher payouts.
Yes, absolutely. And we're doing a lot of that right now. We have a pretty good sized book of business, Peter. So, we have things that come up for renewals. So a lot of times we'll have the ability to increase the interest rate or, some of the rates, of growth compared to, that can coincide with the S&P 500's upside. Just a number of different tools and mechanisms that we have the ability to put into play, and that's the nice thing about being the independent fiduciary advisor that we are is, we do act in the client's best interest. So we want to look across at, what are all the different asset classes? We don't like to just turn off something and say, well, no, we can never use this. This never makes any sense ever. And that's not the case. I mean, there's 300 million people live in this country. Everything's got a use. When it's used in the right way and in the right place, in the right situation for the right client, that's where you get a win-win situation. If you try to do too much of one thing, that's where, you're probably not serving the client's best interest. And, we're proud that we do serve the client's best interest.
That is that fiduciary responsibility of an investment advisor representative, ladies and gentlemen, helping you to navigate when making recommendations or managing accounts, looking out for your best interest. And that is what Chris McIntire and the team from McIntire Retirement Services strive to do each and every day. And if you would like to get your game plan for retirement put together, pick up the phone, give a call, 419-332-0532, 419-332-0532, 419-332-0532. So again, we are entering into a different environment. For the last 5 years, rates have been climbing. Now rates are beginning to fall, expected to fall even further. Chris, just sort of a recap here. Are falling rates, will falling rates be good or bad for different sectors of the economy? Good or bad for the housing market? I got to imagine falling rates probably stimulates the housing market, right?
Yes, and it could certainly use some stimulation for sure. We got a lot of people who would like to be first-time home buyers, and when they lowered interest rates here recently, mortgage rates actually did come down. Sometimes they don't because mortgage rates are more tied to the U.S. government bond yields than they are the Federal Reserve rates. I'll give you an example. When they cut rates earlier in the year, the U.S. Was having a problem with their deficit spending and all of that. So, government bond yields actually went up and they cut interest rates, but government bond yields went up and mortgage rates went up. We're on the other side of that now, and rates have started to come down. So there was a massive amount, a huge volume of real estate transactions just here within the last couple of weeks for people that are coming off the sidelines. And, I believe right now, Peter, I think we spoke on last week's show or the week before, there's more than $7 trillion in money market accounts right now. So, some of that money people might have earmarked for a home purchase. They don't want to risk it in the stock market. And, so if rates come down significantly, and myself looking, at a potential real estate investment, the interest rate is certainly, one of the biggest pieces here. I want it to come down, another half to 3/4 to 1% would be fantastic for the overall real estate market, residential and commercial as well, buddy.
For the stock market, Chris, a lot of companies do rely on financing and probably going to boost, especially maybe those smaller up and coming companies.
Yeah, absolutely. Cheaper money means higher corporate profits. We're spending less on interest. We're putting more back into research and development.
However, Chris, for conservative investors, for savers looking for yield, looking for interest, falling interest rates are not going to be a good thing for them.
That's correct. And keeping up with inflation is going to become more and more of a challenge like it had been for many, many years. So you might want to look at locking in some rates right now.
And income as well. If we're looking for yield, if we're looking for that pension style income, if we're looking at annuities, it probably will not be a good thing there. But now is the time, if you are in those latter two, if you're looking for interest, if you're looking to lock in higher rates, yields, and income, Chris, now is the time to look at that.
Yeah, it certainly is. And, as we go in the future, I don't think rates are going to go back down to zero unless we have some sort of geopolitical event that we don't necessarily see on the horizon right now. But things can change quickly in the world we live in today.
Well, interest rates do affect almost every corner of the financial world and do impact our lives, from debt to interest to mortgages, even impacting the stock market and retirement income. And as rates fall, opportunities shift. So we need to be ever present and to be able to adapt with that. And that is what having a plan allows you to do more efficiently and effectively, ladies and gentlemen, is you have the goal in mind, and then you can make shifts and changes along the way. It's like a GPS. If there's a traffic jam or a detour, it's going to reroute. It does take some rerouting. You don't want to continue on in that same direction when conditions change, but having the plan and having an advisor that you work with allow you to navigate these changing conditions, which we are seeing. So make sure that you have updated your plan and your approach, and that's what Chris McIntire is helping his clients at McIntire Retirement Services do each and every day. And if you'd like to get together your game plan for retirement, pick up the phone, give a call, 419-332-0532, 419-332-0532. Specifically, if you'd like to learn how to retire, how to generate income, control, manage, and minimize taxes, claim Social Security, address healthcare concerns, leave that positive, impactful legacy, that's what the game plan for retirement is all about. Make it your game plan for retirement. Pick up the phone, give a call, 419-332-0532. And Chris, I always appreciate the time, the insights that you provide here on the program. Thank you for being our resource.
My pleasure. Hope you enjoyed the show, everybody. Be safe out there. Thank you, and God bless America.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.